Hello, everyone. This is Chapter 5, Part 1, and it's about inventories and cost of sales. So let me go ahead and share my screen. Okay, here we go. What we're going to do first is how to identify the items in inventory, and then also cost of that merchandise inventory. So to determine inventory items, we have to take a physical inventory count, right? We take a physical inventory of goods on hand. And part of that process is to determine the ownership of goods in transit or on consignment. Goods in transit would include goods that's in transit, like on a truck or something. You've paid the freight, so it's yours. Even though it's not at your place of business, you own it and you need to put it into your inventory. On consignment means that you're giving your inventory to have somebody else sell. Okay, so you would, even though that it's another location, it's still your inventory, and you would include it in your inventory count. Now, there are some reasons why we have to take a physical inventory count. Even under the perpetual system, we need to take an inventory count. And you say, well, why? If we track merchandise coming in and going out in this perpetual system, then we should know what has gone out and what's in an inventory all the time. It should be updated. Well, that's true, but we need to check the accuracy of inventory records. So we have to determine the amount of inventory lost due to wasted raw materials, shoplifting, or even employee theft. Okay. Now, under the periodic system, we track it coming in, but we don't track it going out. So how do we know what our cost of goods sold is if we don't track it going out? Well, we determine the inventory on hand. And so the difference between what was available and what we had left in an inventory must be cost of goods sold. So under the periodic system, we determine the cost of goods sold after taking an inventory count. Okay, remember that formula: beginning inventory plus purchases equals amount available minus ending inventory is cost of goods sold. So in the periodic system, that's how we determine our cost of goods sold. Now, these three items require special attention: goods in transit, goods on consignment, and goods that are damaged or obsolete. So let's take a look at each one of these. Goods in transit are goods that have been purchased, but you haven't received them yet, or goods that you have sold, but you have not delivered them. Okay, so for goods in transit, you would include those goods in your inventory if you have legal title to those goods. And the legal title is determined by the terms of the sale. Is it FOB shipping point or FOB destination, right? So if it's FOB shipping point, the purchaser pays, right? So if it's FOB shipping point, while it's on the truck in transit, it still belongs to the buyer. So even though it's the inventory is still on the road, the buyer would include it in their inventory count. So let's take a look at this. Okay, FOB shipping point, goods are included in the inventory when it's shipped. Why? Because if it's free on board at the shipping point where the seller is, as soon as the seller puts it on the truck, it becomes the buyer's inventory. So even though that the inventory is not there yet, the buyer would include it in the inventory count. Now, if it's FOB destination, well, who's at the destination? The buyer. It's free on board to the buyer, so the seller is paying the freight. So as long as that that inventory is on the truck, it belongs to the seller. So the buyer would not include it in their count until it arrives, because title will pass as soon as it's delivered at the destination, at the buyer's place. So this is it. So if it's FOB shipping point, it's free on board to the seller. So as soon as the seller puts it on the truck, ownership passes, right? So even if it's on 99 coming to Fresno, you would include it in your inventory. Now, if it's FOB destination, it's free on board at the buyer's place. That means the seller has paid the freight. So as long as it's on the truck, it does not belong to the buyer. It's the seller's. So when does title pass? Well, as soon as it's the merchandise inventory is delivered to the buyer. Ownership passes here at FOB destination. Goods in transit should be included in the inventory of the buyer when the terms are FOB shipping point. Remember, FOB shipping point, the purchaser pays. So goods in transit that are on the truck belongs to the purchaser. So that purchaser would include that inventory in the inventory count, even though it's still on the road and on the truck. The next concept is goods on consignment. And merchandise is included in the inventory of the owner, who we call the consignor. Let me give you an example. When I was 16 years old, I had a small organ speaker and I wanted to upgrade. So I wanted to sell that organ speaker. At the age 16, I had no idea how to do that. So what I did, I went down to Soundstage, and that used to be on Blackstone. And I said, could you sell this organ speaker for me on consignment? And they said, yes. So the thing is, that organ speaker was at Soundstage, but if Soundstage did an inventory count, they would not include my speaker because it wasn't theirs, it was mine. I would still include it in my inventory if I was a business, okay? So the consigned goods held by a company, the consignee, in my example, that was Soundstage, should not be included in the company's inventory. Okay, I think I'm not going to do this one. I think we're okay. Let's talk about goods that have been damaged or become obsolete. Okay, so if you have damaged or obsolete goods, but they can be sold, they would be included in inventory at realizable value, meaning the sales price minus the selling cost, right? So if it is partly sellable, then you can put it in the inventory and cost it out. If it's not, if it's totally gone, then you don't include it. Okay, so we've done this in chapter 4, where we have seen some damaged merchandise, and we need to adjust for shrinkage, right? So if we do that, in this example, there was $250 worth of shrinkage. And so in this case, we reduce our inventory by the shrinkage, by the damaged goods. And where do we put it? Well, we just add it to the cost of goods sold, right? Which is cost of goods sold expense. All right. Let's go ahead and determine inventory costs. And Inventory costs include the invoice price, right? But you subtract any purchase discounts for early payment. And there's other costs that would include shipping, storage, insurance, and import duties. I'm going to use the next slide to explain all of these. Okay, so what would be in our merchandise inventory account? What is the cost of our merchandise? Well, first, what we pay for it, right? The invoice cost. But if we get a discount for early payment, then the merchandise inventory didn't cost us as much as we thought. So we will reduce it by the discount, the early payment discount. If of course, if we returned it or we got an allowance on it, right? Well, they're getting it for allowance, they're giving us off the price. That would reduce our merchandise inventory. Now, let's say that you deal in international business and you want to buy goods overseas and bring them in. And if you do, you might be subject to import duties. You know, I was interested in this keyboard that was made in Italy, but man, I tell you what, you know, if I bought that keyboard in England, it would be $1,700 less. But because it's in the United States, they have to pay those import duties. It's a lot more. So import duties is just taxes imposed by the folks that import the inventory. And so those taxes are just another inventoriable cost. It increases the cost of merchandise inventory. The next one is freight. Now, we talked about this before, because not only is the cost of the merchandise inventory the purchase price, but it's also any cost to bring it to its place of business and get it ready for its intended use. Okay, so here we're going to add the freight charge. If we have to pay freight, that's going to be debit merchandise inventory, because that freight charge increased the cost of that merchandise. Now, what's this plus insurance? Well, remember when I said, you know, you paid the freight and it's in the truck going down 99, and all of a sudden the truck was in a bad accident, it crashes and burns, the inventory is gone, it's a big loss. Well, what people will do is they'll insure it while it's in transit, right? It's just while it's in transit. So if something bad like that happens, you're covered. So the cost of that insurance would be debit merchandise inventory. Now, remember I said that the merchandise inventory is not only the purchase price, but getting it to our place of business, which would be the freight and the insurance in transit, but also getting it ready for its intended use. Hence, we have plus storage. And you're thinking, well, how could that be? Well, I had to think long and hard to give you guys an example, but there are two examples. You know, wine. Wine has to be aged in these barrels, right? And so part of that aging process is getting that wine ready for its intended use. So that the storage cost in those, I don't know what it is, the barrels, would be debit merchandise inventory. It's just another cost of the inventory. Another one would be cheese. You have to age cheese as well. So the act of doing that and get it ready for its intended use, the storage of that while that process happens, would increase our merchandise inventory account. Okay, let's try a quick study 5-1 and 5-2 on page 228. So let me end the show. Actually, I didn't even have to end the show. I think I did it this way, but anyway, we'll be fine. So if I do this, there we go. Okay, quick study 5-1, page 228. 228. Homestead Crafts, a distributor of handmade gifts, operates out of owner Emma Finn's house. At the end of the current period, Emma looks over her inventory and finds that she has the following. Determine how many units Emma should include in her period in inventory. Okay. Number one, she counts 1,300 units in her basement. Okay, so we'll put that 1,300 units in, but 20 of which were damaged by water and cannot be sold. So we have to back that out, less the 20 damaged units. And then there are 350 units in her van ready to deliver per customer order, terms FOB destination. So it's free on board to the destination. That's at her customer's place, right? So she's the one that's paying the freight, which actually she's delivering it herself. So that in transit cost is going to be her cost, which is you should, it's her inventory. I'm sorry, not her cost. Well, it'd be her inventory. Okay, so she's going to put those units in the inventory. And then we have 80 units on consignment to a friend who owns a retail store. Okay, she doesn't have them, but she gave them to a friend, but even though she doesn't have them, it's still hers and she needs to put them in. So there's 80 there. So what's in Homestead Crafts ending inventory? 1,710 units. Okay, let's go ahead and do quick study 5-2, page 228. Okay, so here we have a car dealer who acquires a used car for $14,000. Yeah, good luck on doing that now with inflation. It cost you like $40,000 for a used car now. It's with terms FOB shipping point. Okay, so the car dealer is the buyer and it's FOB shipping point. So the purchaser pays. Well, the car dealer is the purchaser. So it's going to be, the freight charge is going to be paid by the car dealer. Compute total inventory costs assigned to the used car if additional costs include the following. Okay. Well, first off, what's going to be the inventory cost of this car? Well, the purchase price. We'll put that in, $14,000. How about the transportation in of $250? Well, yeah, because it's FOB shipping point. So the purchaser pays, and that car dealer is the purchaser. So they're going to have to include that in the car's price. It's or the car's cost to the dealer. Okay. How about shipping insurance? Yeah, while it's in transit, that would be an inventoriable cost. Put that in, $300. How about the $900 for car import duties? This must be an exotic car or something from overseas. Okay. Yeah, import duties, those are the taxes that for doing that. That's going to add to the inventory cost. How about the $150 for advertising? No, that'd be advertising expense. It's not an inventoriable cost. How about the sales staff salaries for $1,250? No, that would be a selling expense as well. And this gets me. I mean, how about the $180 for trimming shrubs? Boy, if you said that, I don't know what to do. No, it doesn't belong there. So the total cost is $15,450. Let's go back here. Okay, now we're going to start computing the cost of inventory here. Remember this formula for cost of goods sold? beginning inventory plus purchases equals amount available minus ending inventory is cost of goods sold. Okay. So beginning inventory of 1 plus how much we purchased. So we had 10 available. So if we count any inventory of 3, then we know that 7 must have been sold. Now the question is, in ending inventory, which ending inventory items are included in ending inventory? Okay, so these are our possibilities. Would it be, we need 3, would it be 1 of these and 2 of these, these purchases, or would it be all from the January 13 purchase? That's the question, right? Remember, this amount available is made up of all these purchases. So of the 3 ending inventory, which ones are they? Which ones are still in ending inventory? Like I say, it depends on our inventory method. And we're going to be going over FIFO, LIFO, weighted average, and specific identification. Okay. So at this point, I'd like to go over a handout that I gave you in Canvas. It's under Bring to the Session, and it's really, really good. Matter of fact, let me get it, and I'll tell you why it's really good. You need to write this down. This is the handout that I used as part of my presentation to my hiring committee. Because of this, I was hired over 26 years ago. People on that committee said, I'm not even an accountant, but I understand what you just said. You were pretty amazing. I thought that was pretty cool. So this is really, really the one that got me the job over 26 years ago at Fresno City College. So what we're going to do here is we're going to calculate ending inventory using these 4 methods: specific identification, weighted average, FIFO, LIFO. And so I'm going to use the same situation here. Let's say that we made the following purchases during the month of January. Okay, so I'm going to move this up here. We started out with beginning inventory with 100 units at $10. On January 7, we purchased 100 units at 15. And then on January 15, we bought 100 units at 20. And on January 24, we bought 100 units at 25. Wow, there's major inflation here. And we think we have problems today, but this is like Venezuela. Because they really have some problems with inflation. Okay, now in this scenario, we know that out of the 400 units, right? We count them 100, 100, 100, 100. There's 400 units available. But in this scenario, we only have 160 units remaining in ending inventory. So if we have 400 units available, yet we count only 160, how many units did we sell? Well, 240, right? 400 units minus 160 would give us our cost of goods sold units at 240. So the question is, which of the 160 units are still in ending inventory? Would it be 100 of these and 60 of these? Or would it be 100 of these and 60 of these? Well, it all depends on what kind of inventory method we use to value the inventory. We're going to start out with specific identification. And in specific identification, you keep track of each unit coming in and each unit going out. Now, to do that, each inventory item must have a distinguishing feature or marking for identification. It's used for expensive or one-of-a-kind items. For instance, pianos, cars, or fine jewelry. So let's say that, that you are a Steinway piano dealer. Well, each Steinway piano is like $80,000, right? Well, you know that you have that particular piano, and there's probably a VIN number or something, or not a VIN number, but some type of serial number to identify that piano. You know when it comes in and you know when it goes out. Now with cars, let's say you're selling a Honda, and you buy, the car dealership buys a Honda Accord. Okay, well, you have that car. It has a VIN number, it's there. And when you sell it, it's that particular car that you sell. So that's what specific identification is. So we'll leave that there, write that in. Now, the first method, which is a cost flow assumption, is this. Sometimes we can't, keep track of each item, right? Like in a grocery store, you can't keep track of every can of green beans going out. There's not a specific identification for a can of S&W green beans. So you'd have to use one of these cost flow assumptions. The first one is the weighted average. And this involves calculating the average cost of items in inventory. And the basic formula you have to remember is the cost of units available divided by the number of units. Now, this weighted average is used by inexpensive accounting programs such as QuickBooks. And why? Because of the different methods. It's the middle of the road results, right? It's, if you do, we're going to be doing FIFO, we'll be doing LIFO. Those will give you more extreme results, but weighted average is kind of in the middle. So if you pick one, then maybe that's the best way to go. So QuickBooks uses weighted average. Now, how do we do this? Well, we got to find the average cost of the units. So we know we've got 400 units available, right? And what's the cost of those units? Well, 100 units times 25, 2,500. 100 units at 20, 2,000. 100 units at 15, 1,500. 100 units at 10, 1,000. So the cost of these 400 units is 7,000. Well, what's the average cost of each unit? Well, take total cost divided by total units. So the total cost is 7,000. Divide that by the total units of 400. So on average, each unit is going to cost $17.50. So to figure out what's in any inventory, and remember, these numbers will never change. Ending inventory is always going to be 160 units. Cost of goods sold is going to be 240 units, just like the page 1 of the handout. Okay, so then how are we going to cost out those 160 units in ending inventory? By the average cost. So 160 times 17.50 equals 2,800. Likewise, we have 240 units in our cost of goods sold. And we're going to value each of those units sold at the average cost of $17.50. 240 units times 17.50. That's going to give us a cost of goods sold of 4,200. Now, there's another way of doing it, and you need to write this down, because in your homework or in the chapter, they're going to have you work it this way. If you know that the total cost is 7,000, that's what's available, but you only have 2,800 left in any inventory, then your cost of goods sold would be the 7,000, right, available minus the ending inventory of 2,800 will give us cost of goods sold of 4,200. I do it this way so you can kind of see it, how it all works here. But this is a very typical way of figuring it out. You know what's available, ending inventory, and the amount available minus the ending inventory will always give us our cost of goods sold. Okay. Let's go and do FIFO, first in, first out. Now, I like to say first in, first sold. Now, remember, FIFO is good for perishable items, as, for example, the milk display case, right? FIFO assumes that the oldest milk is sold first, right? So when you think of FIFO, think of milk display case. You know how the grocery clerks, they take the oldest milk, right? The one they purchase first, the oldest milk, and they push it forward. And then you take that milk that's in the front, right? Yeah, right. You don't either. I don't as well. You'll grab at the back, try to get the freshest milk. Yeah, I know you. Well, I do the same thing. So what you have to remember is that FIFO is an assumed flow of the goods. It may not follow the actual flow. So customers may reach in the back for the freshest milk. But all in all, it's going to work better. I mean, it's better than doing another method, right? So anyway, FIFO, think milk display case, and it assumes that the oldest milk is sold first. So how does this work in our example here? Okay, so this time we have 160 units in ending inventory, and we have 240 units to cost of goods sold. Well, which ones are in ending inventory? Well, first off, think of this: first in, first out. So first in, first sold. These units, 100 of these, 100 of these, and 40 of those, the 240 here, are the ones that went out, right? Because they were there first. So what's in ending inventory? It'd be 100 of these at 25, and then 60 of these at 20. So that's what I did. 100 at 25, 100 units at $25. I've got 2,500. And then I'm still not done because I need 160. So I need 60 more. So of that 100 units, I'm going to use 60 of them, right? And bring them down. So 60 at $20 is 1,200. Okay, so, and then you cost that out. And so you know that 160 units will be valued and costed out at 3,700. Now, on the cost of goods sold side, you need 240 units. Remember, it never changes in this example. There's always going to be 160 units in ending inventory and 240 in cost of goods sold. Well, in, first out, these are the ones that are first in, so they went out first. So 200 of these at 10, 100 of these at 10, 100 of these at 15. Now we're up to 200. We need 40 more. So 40 of these at 20 go here. Cost that out, 100 at $10, 100 at 15, 100 at 40 at 20. So those 240 units are going to be costed at 3,300. Now, again, remember the amount available from before all this was $7,000. So if the amount available is 7,000 and we know our ending inventory is 3,700, then our cost of goods sold would be amount available of 7,000 minus what we had left, which is the ending inventory of 3,700, will equal cost of goods sold of 3,300. Okay. Now let's talk about LIFO, last in, first out. When I think of LIFO, last in, first sold, these are good for, this is good for non-perishable items like nails, sand, coal, and steel. Okay, so in LIFO, last in, first out, the last ones in are the first ones to go out. Now, when you think of LIFO, I want you to think of a barrel of nails, right? Now, you're not going to dig deep down at the bottom for the oldest nail, right? God, can you imagine doing that? You'd be a bloody stump trying to get your hand down there. What you're going to do, oh, did I actually say that? Shouldn't say that. Bad instructor, huh? Okay. It's going to, this whole barrel of nails thing is going to be etched in your head though. So what I'm saying is in LIFO, you're going to take the nails from the top of the barrel. The last in are the first ones to go out, right? So write that down, barrel of nails. LIFO assumes that the newest nails are sold first. Now write this down too, and I'm going to explain this not in this session, but in the next session. In times of rising prices, LIFO results in the highest cost of goods sold and the lowest net income. This is a tax shelter for the rich. And so if, let's say that, you're trying to minimize your tax liability and you have your choice, LIFO or FIFO. The rich guys are going to choose LIFO. Why? Because if in times of rising prices and those newest nails cost more, that means you're matching the highest cost of goods sold, right, to net income. So highest cost of goods sold will cause lower net income, which will cause less tax liability. So remember, this is one of the methods that if some of you guys who become rich and you use this and you remember that Tetrop told you, then you can show your appreciation by buying me a red Porsche Turbo Carrera. Okay, I like red. I'll take any color, but red's my favorite. So if you become a multimillionaire and you used what I told you here and you want to show your appreciation, just get me my Porsche. I appreciate it. Okay, enough said on that. Did I ever tell you that I did have a student that gave me a red Porsche Turbo Carrera? Unfortunately, she didn't become a millionaire, but she did find a Tonka toy. It was like a really nice one, but it was a toy of a red Porsche Turbo Carrera. And I still have it. I think it's really cool that she did that. That was fun. Okay, let's cost this out. Okay, so LIFO, last in, first out. Well, these are the last ones in. So these are the first ones out. So these went out. So what's in ending inventory? It'd be these. It'd be 100 of these and then 60 of those. So here we go. 100 at $10 would be 1,000. And then in this layer, we're going to use 60 of these at 15. And that's going to cost out at 900. So my ending inventory is going to be valued at 1,900. Now, what's cost of goods sold? Well, it's going to be the ones that were bought at the latest time. And so it'd be 100 of these, 100 of these, and then we still have 200. We still need 40. So we'll go 40 at 15. So here we go. 100 at 25, 100 at 20. And now we need 40 more. So we'll take 40 of these. We cost it out. And so the 240 units, we cost it out at 5,100. Now, the alternate calculation is this. The amount available, which we know from before, is 7,000. And what we had left in inventory was 1,900. So cost of goods sold would be 7,000 and minus the 1,900 would give us cost of goods sold of 5,100. But the amount available, then any inventory is what we had left. So what did we sell? We must have sold $5,100 worth. Okay. All right, let me go ahead and we're going to go ahead and go back to this. This is another way of looking at it, and I kind of like this. This is from your book. So we have 3 items, right? We purchased each this one item in May 1 for 45. We purchased the next one on May 3rd at 65. And we purchased this one on May 6th at 70. Okay. Now for each one of these examples, 1 unit was sold and 2 units remain in ending inventory. So which unit was sold? And which 2 remain in ending inventory? It depends on our cost flow assumption. In FIFO, what was sold? Remember, first in, first out. Well, what was the first one in? The one on May 1, the $45. That goes into our cost of goods sold. Well, then the other 2 must be in ending inventory. And hence we've got the one on May 3rd and the one on May 6th. Together, those 2 would be $135. Okay. That's what we calculate ending inventory at. Now, under LIFO, it's the same inventory and everything and the same cost. But now, because it's LIFO, we do it differently. 1 unit was sold. Which one was sold? Well, last in, first out. The last one in is the first one out. Well, which is the last one in? The one on May 6th. So that's the one that's going to go out. That's going to be to our cost of goods sold. Well, then the 2 that are remaining would be these, right? One at the 45 and one at 65. You add those 2 together, that's 110. So these 2 go into our ending inventory. Now, the last one is weighted average. We have the same 3 units and everything. They cost, the same. But what we're going to do to calculate this, these are the items available. We're going to add them all up to find our total cost available, right? 45 plus 65 plus 70. That's $180 for all 3 of them. And well, how much is that on average? Well, if you divide it by the 3 units, on average, each unit costs $60. Okay, so for that 1 unit sold, we'll take one of those at 60. It goes here to cost of goods sold. The other 2 at 60 a piece will go into the balance sheet to our ending inventory. I'm going to kind of blow this off. I don't think we really need to know this. Know that FIFO is mainly used in the field, right? If you got to say, well, what are people using? Most people are using FIFO because it follows the natural course of things. Usually the inventory that you buy first, you want to sell first, right? So that's why it is. But as we know before, by the milk display case, the actual flow of goods may or may not follow our cost flow assumption, right? People like us, it may be the grocery store is using FIFO for their perishable items like milk, and they push the oldest milk forward and they want us to take from the top. We don't. We take in the back. Well, that kind of messes them up a little bit, right? So remember, it's a cost flow assumption. The only one that's not an assumption is specific identification. Why? Right? Because they tell you which ones were sold. But in these other ones like FIFO, LIFO, and weighted average, they're cost flow assumptions. Okay. Now, I'm going to reinforce this periodic system because it's the easier one. Now, I will tell you that the homework is based on the perpetual method, and we'll start working on that fairly shortly here. But I wanted to give you a really good, solid foundation in this. So when you do the perpetual method, it won't blow your socks off, right? So a lot of people like this chapter because it's a little bit easier for them to understand. I hope that's the case for you. Okay, here we go. We got first in, first out, right? And we have 450 units in ending inventory. Okay, so first step is, well, which 450 units are in an inventory? Is it 400 of these and 150 of these? Is it 100 of these, 200 of these, and then that'd be 300. Then we need 150 of these to get to our 450. Well, let's think this through. First in, first out. These went out. These are the first ones in, they went out. So what's in any inventory? It would be these, right? Down here, our newest ones. The first ones that we bought went out. So here we go. So we've got 400 at 13. And then we still need 50 more. So we'll go 50 of these at 12, right? Okay, so let's cost that out. So those units, those 450 units will be costed at $5,800. Now, we have $12,000 available for sale, right? Because we extended this out, and we know that those 100 of those 1,000 units cost us $12,000. So if we had 12,000 available, we only had 5,800 left. What's our cost of goods sold? Well, cost of goods available for sale minus any inventory would be cost of goods sold. Remember, this is amount available minus any inventory is cost of goods sold. All right. Let's go ahead and let's do LIFO. Again, 450 units. Well, which ones went out? Last in, first out. So last in, first out. These down here went out. So then the ones up here are remaining in the inventory. So we need 450 of them, and we're going to start here. 100 at 10, 200 at 11, and now we're up to 300. We need 150 more. So we'll take 150 of these at 12. Yeah. And then let's cost it out. So those 450 units will be costed out at $5,000. That's what our ending inventory is. Now, if we had the amount available was 12,000, we only had 5,000 left. What's our cost of goods sold? Well, 12,000 minus our ending inventory of 5,000. Our cost of goods sold would be 7,000. Okay. Weighted average. I kind of like this one. It's kind of fun. What we have to do is we have to find out the average cost. That's what we're going to assign our units. You know, that 450 units, well, we're going to find the average unit cost and multiply it out, and we're done. So what is that? Well, the total cost is 12,000. And how many units is that? 1,000 units. So on average, our unit cost is $12. So to find out our ending inventory cost, the 450 units times the average cost of 12, excuse me, our total cost is 5,400. Then again, how do we compute the cost of goods sold? Well, the amount available of 12,000 minus the ending inventory of 5,400 would give us our cost of goods sold of 6,600. Okay. Now, your homework is going to be based on the perpetual system using the methods of specific identification, FIFO, LIFO, weighted average. I wanted to give you a good, solid foundation about how FIFO, LIFO, weighted average works. And now I'm going to show you how it applies in a perpetual system. Basically, we have to update our in inventory and what we sold in real time. So it just, the calculations happen more rapidly than we do on the periodic basis that we just did. But you'll see what I'm saying. In so specific identification. Okay, here is matter of fact, I think this is, do we do this for each of them? Well, anyway, this is what happened. We started out with beginning inventory of 140 units, bought them at $6. And then on January 10, we sold 100 units and we sold them for $15. Hey, just disregard that sold at retail. You were never going to use it. I don't know, it's just kind of confusing. I don't know why they put it in there. So, but you need to know that you did sell 100 of them, right? And then you purchased 60 more on January 20th. Then on January 25th, you sold another 80. And then on January 30th, you purchased another 180. Now, we want to determine the cost assigned to ending inventory and to the cost of goods sold using specific identification. Now, under specific identification, they tell you what is in your ending inventory. They have to do it. That's what specific identification is. It's not a cost flow assumption. They got to tell it to you. And when you do your homework, that's the same thing. So what is the ending inventory? Well, here they say that our ending inventory consists of 200 units, where 180 are from the January 30th purchase. Okay, so we'll put 180 there because that's our ending inventory. 5 are from the January 10 purchase. Okay, so January 20th purchase, yeah. So that would be here. And then 15 were from beginning inventory, so that we'll put that there, right? So this is what we had available, but then at the end, they told us we had 15 left from the beginning inventory, 5 from the January 20th purchase, and 180 from the January 30 purchase, right? Okay. Let's go and cost it out. Well, if we had 140 available, we had 15 ending. Well, how many did we sell? Well, 140 minus 15 is 125. And what about this one? Well, if we had 60 and we had 5 left, 60 minus 5, well, we must have sold 55. And then here we had available 180. We still have 180, right? So we didn't sell anything, so it'd be 0. So let's go ahead and cost them out. So that 125 units is at 140, cost that out at 75. That 55 units is going to be cost out at $5. And this 0, I guess we put it over there, it would be 450. And the cost of goods sold from that layer is 0. Okay. So we know that our cost of goods sold then is 1,025. Okay, let's cost out our ending inventory. Again, 15 units at the 6. So our ending inventory is 90. And then we had 5 units at $5, cost that out. That'd be 25. And then, of course, we have 180 units at the 450. So that would be 810. So our ending inventory is 925. Okay, so let's just go ahead and do what we all know. Beginning inventory, that was 840, right? Plus purchases. And what do we purchase? We purchased $300 here and $810 there. That would be $1110, right? So we purchased $1110. So beginning inventory plus purchases equals amount available and that's 1950. Okay. And then we're going to go minus ending inventory of 925. So what's cost of goods sold? Well, goods available minus the ending inventory of 925. That'll be cost of goods sold of 1,025. And guess what? It matches here. Okay. How about that? Okay. 125. Now, we're going to do first in, first out perpetual basis, right? And remember, when you think of FIFO, you think the milk display case. The first ones in are the first ones out. So we know that the older costs, the ones we bought first, are going to go to cost of goods sold. That means what's in inventory? The most recent costs are in ending inventory. Okay. Okay, here we go. Let's go ahead and do FIFO. Now, this is how you are going to do your homework, and you're going to keep these columns, right? And so I'm just going to go through it here, and then I have a handout too that you were going to do. But now you can just kind of watch the show. After we do this one, you and I are going to do one together. Okay, here we go. We start out with January 1, beginning inventory of 140 units at $6. Okay, so on January 1, we had 140 units, and it cost unit cost of $6. So that's we'll bring that over 140 at $6. Our inventory balance then is at $840. So we're always going to keep track of our ending inventory. And you're going to see here that we're going to be building layers. And then when we sell it, we're going to be taking away layers. And so anyway, we're just going to add to the layers here. So here on January 10, we sold 100 units. Okay. January, we hold 100 units. Now, what did we sell? If we look at ending inventory, we only have one layer to choose from. You know that 100 units had to come from this layer at $6. So we know that the unit cost is going to be $6. So our cost of goods sold will be 600. Now, we had 140 units, but we used 100 of them. So what's going to be our new layer? Well, we only had 40 of them left, right? We had 140, we sold 100, we have 400 left, and of course, they're costed at $6. So now our ending inventory is only $240. Here we go. On January 10, we purchased 60. Okay, let's go ahead and we purchased 60 at a cost of $5. So let's go ahead and we're going to add the layer. Now, what we're going to do is we're going to bring this layer 40 at $6 down first. And then we're going to add the second layer at 60 at $5 for a total cost of $300. Okay, so right now we've got 100 units and we'll cost them at $540. Okay, so remember, we built a layer. We have one layer at 40 at $6 and another layer at 60 at $5. Okay, now looks like we're going to be selling 80 units on the 25th. On the 25th, we're going to sell 80 units. Now, the thing is, I jumped the gun on this. Which 80 are they? Is it going to be 40 of these and 40 of those? Is it going to be 60 of these and 20 of those? Well, because it's FIFO, first in, first out, we're going to take 40 of these at $6, right? So that we're going to wipe that layer out, right? I mean, it's zero. We had 40, we're using the 40. And so we've got zero now. We use that whole layer. Now we got to go to this layer. And out of that 60, how many do we need? Well, we need another 40. So we're going to take 40 of these at 5. And there we have it. Okay. So if we had 60 and we use 40 of them, now we only have 20 left. And of course, that would be at $5. So now our in the inventory is going to be, it looks like $100. Yeah, they do it backwards. So we have to add up what our cost of goods sold was, which would be 440, right? Add those two, and then we add this, and now we know that these 20 units are going to be $100 worth. Okay. Last but not least, we purchased 180 units at $450. Okay. January 30th, 180 units. So we're going to purchase them at $450. So what we need to do, though, we need to take this layer down. The publisher did this. They're going to take this layer too, but I wouldn't even do it because it's 0. But I guess they want you to see it, but it's 0. I don't even know why they want to carry it down, but there's nothing there. But we do need to carry down this layer, right? Because we got 20 at 5. So we got 100. We're bringing down the layer, and now we purchased 180 more. We're going to add that to ending inventory and create another layer of 180 at $450, which would be $810. So what's our ending inventory? Well, we have 200 units, and we're going to value it at $910. Now, what about our cost of goods sold? Well, we've got cost of goods sold here of 600, and we got cost of goods sold here of 440. You add those together, and we've got a cost of goods sold of 1,040. Let's go ahead then and put it into our little schedule. Beginning inventory of 840 plus purchases. Remember, we have purchased $300 worth on the January 20th. We purchased another 810 on January 30th. So these two, 300 plus 810 is our 1,110. So we have goods available here of 1,950. So if we subtract our ending inventory of 910, we should have cost of goods sold of 1,040, right? The amount available minus ending inventory will be cost of goods sold. And notice it agrees. So we are good. We are good. Okay. We're going to go ahead and do a handout, and it's in Bring to the Session. And you need to write it down. I know a lot of you guys are probably on your bed in your pajamas watching this video, kind of like you're watching a movie. But really, my lectures are meant to be interactive. So when you watch the videos, you're supposed to be writing notes and filling in things and working the problems with me. Even if you don't know what's going on, just by the fact you're writing it down, it really helps you learn. Anyway, I'm going to go ahead and stop the or end the show here and try to find my, oh, I know what it is. It's this one here. There it is. Now, this quick study 5-4 is from the 7th edition or something. Our edition, I think it's quick study 5-5. So ours, it's 5-5 on page 228. I was just so tired of having to change all my handouts just because the book rearranged their material. So anyway, we're going to go with this. So let's read about this. We're going to skew FIFO and we'll call it a day. A company reports the following beginning inventory and purchases for the month of January. And then on January 26th, the company sells 350 units and 150 units remain in ending inventory. Well, let's write this down. We start out with beginning inventory of, well, 320 units at $3. So we start out with an inventory balance of $960. Okay, now on January 9th, we purchase 80 units at $320. Okay. Now, what we want to do is we want to bring down our original layer of beginning inventory and bring it down here. So it's $320 at $3 a unit. And then we're going to add to that layer 80 at $320. So that's the secret to this whole perpetual thing. Just add to your layers when you purchase. So this was our original layer. We bring it down. When we purchase something new, we add to the layer. So trust me, I'm a professional. I have an honest face. If you cost that out, you know that we're at 1,216. Now, on the 25th, we bought 100 units at $3.34. Okay, so here we do. We got goods purchased 100 at 3.34. Well, before we add it, we need to bring down our original layers. So we have 320 at $3. We have 80 at $320. And now we're going to add our new layer of 100. So 100 at $3.34. And trust me, if you extend all that out, your ending inventory balance will be 1,550. Now, this is the interesting part. On January 26th, we sell 350 units. Okay, so on the 26th, we're going to have to take, use our layers. Well, this is LIFO, first in, first out. So we're going to take the oldest one, the original layer, and go 320 at 3 and put it to cost of goods sold, right? And if you notice here, when we use that layer, it's all gone. We use a whole 320, and now we have nothing in an inventory. It's gone. But we still need, 350, so we need another 30. So of this layer, of this 80 at 320, we'll use part of this layer. So we'll use 30 of them. 30 at 320 will give us 96. We cost that out. That's going to be 1,056. Now, notice that we had a layer of 80. We used 30. We only have 50 left, right? But we put that in. Now, also, we need to bring down the layer that we didn't use. We didn't even touch it. So that whole unit, that 100 units at 334, put it in down there. So we can cost out our ending inventory as this. So you can trust me, if you cost that out, you're going to have an ending inventory of 494. But anyway, that's how it kind of works in the FIFO perpetual system. Next video, I'm going to finish it out. We'll do LIFO and weighted average, and then do some other things too about inventory errors and different things like that. So for this video, I think I'm done. I'm going to go ahead and stop the share. And I just want to say that you should have happy studying. Bye-bye.